How is everyone doing today? Welcome back to another episode of the Banker Next Door. I'm your host, Dr. Joe Berquist. So I wanted to bring everybody an update on FICO scores today. I saw a couple of really interesting articles about different things going on with the credit scoring model, the company, FICO itself, the credit reporting bureaus, Experian, Equifax, TransUnion, and just how it's affecting consumers. So I wanted to share just a few articles with everyone here today. So we're going to pop in with two real quick ones, and then we're going to go to from CNBC, and then we're going to go to one with the Wall Street Journal. So credit scores fall for the second year in a row as more consumers miss payments. So the national average credit score, which had been steadily increasing for over a decade, fell for the second consecutive year, according to a new report from FICO. Increases in credit card utilization and missed payments, as well as the resumption of student loan delinquency reporting, all took a toll. However, not all borrowers are struggling. So the national average credit score, which had been steadily increasing for over a decade, fell for the second year in a row, according to a new report from FICO, developer of one of the scores most widely used by lenders. The average score is now 715, down from 717 in 2024 and 718 in 2023. FICO scores range between 300 and 850. High interest rates and higher prices have been a drag on many Americans' financial standing. Consumers overall are falling deeper into debt, causing an increase in credit card balances and an increase in missed payments, FICO found. That contributed to the average score decline. Now, and then student loans are also playing a factor in this. So we're kind of getting the gist here. Consumers is under strain here a little bit, and FICO scores are going down. Now let's look at this. More consumers are using rent payments to boost their credit score. Here's what to know. So, the share of consumers whose rent payments are reported to credit bureaus rose to 13% in 2025, up from 11% in 2024, according to a new survey by TransUnion, one of the three major bureaus. It's a good thing that more people's rent payments are getting reported to credit bureaus because it can really help people improve their credit, said Matt Schultz, chief credit analyst at LendingTree. Here are key questions to ask yourself before you enroll in a rent reporting service, according to experts. So, um, rent reporting services track a user's rent payment history and report them to one or more of the three credit bureaus, Experian, Equifax, and TransUnion. Sharing rent payment activity is shown to be beneficial for participants, especially those who are credit invisible or do not have any credit history, experts say. Those who have enrolled typically see their credit scores increase. When rent payments are included in credit reports, consumers see an average growth of 60 points to their credit score, according to a 2021 TransUnion report. Rent reporting services can also help younger adults as they are more likely to have short credit histories and to rent, said Schultz. Um, 5 questions to ask. Let's see here. 1, do you truly need it? 2, what is the cost? 3, does the service report to the three credit bureaus? 4, what data does the service report? And number 5, what is the cancellation policy? So a couple of big questions there to ask before you start using the service. Now, I will just say on this very quickly, I think this is a great thing, and this would fall into, in other words, recording rental payments would fall into what a lot of banks would consider to be alternative. Um, how do you want to say it? Alternative data. So so in the banking world, you have what's called hard data and soft data. So hard data would be someone's credit return or with someone's tax returns, their credit report, things that are very quantifiable. Soft data would be, okay, how do we know this person? Or maybe they're really deep in with the community. Maybe they do a lot of nonprofit work. They own this business down the street. Maybe we know who their grandparents, their brother, their uncle, their cousins, their mom, dad. Like could be a whole bunch of stuff, and that would be considered soft data. Alternative data would be things like looking at somebody's rental payments or their utility bills. Maybe looking in a little bit deeper at some of the other things they pay for, like subscription services and things like that. There's been a lot of talk for many years about incorporating alternative data to get a better, kind of view or understanding of how well a consumer does or does not perform in terms of just meeting their paying their bills, paying their obligations, right? So I think this is a good thing. I think a lot of people should report their rent payments. I think it should be reported in there because it really can help younger people to build their credit. So, but that being said, let's continue on. So, okay, so last article here today, and I thought this one was very interesting. So, this is a fight over credit scores turns into all-out war. So, your FICO score has long determined whether you could get a mortgage, car loan, or credit card. That could change soon. So, a $10 fee increase for FICO scores has intensified a battle between Fair Isaac and three credit bureau companies over the credit score control. So, in other words, FICO, for a lot of people who don't know, FICO is the company that actually created what's called the FICO score. That's the score you actually get on your credit report. But there are three credit bureaus. The main three are Experian, TransUnion, and Equifax. Now the three credit bureaus, they license, or FICO license, the credit score model to those three credit bureaus, who then they collect the data and then they put it into the model, and then they generate the credit scores themselves. But they have to pay FICO for the ability to be able to use that model to generate your credit score itself. So it's very interesting how this all works. So, but getting back to the article, so for years, rival executives have been fighting behind the scenes over who controls the most important number in every American's financial life, their credit score. Now, a $10 fee has tipped the sides into open warfare. To the victor will go the power to determine who gets mortgages, car loans, and credit cards in the U.S. and how much they will pay for them. The battle pits Fair Isaac, the creator of the dominant credit scoring algorithm, against three companies, Equifax, Experian, and TransUnion. Those three companies supply the credit files that go into Fair Isaac's score, or FICO score. They are eager to break Fair Isaac's grip on determining credit worthiness, and they think they can do it by offering an alternative, a credit score they created and named Vantage Score. And I have talked about this in other episodes. They really want to use this, particularly in the mortgage market. You have, what is it, the FICO 4.0, and then you also have the Vantage Score. So you have a couple different things being floated out there. But anyway, the FICO score has had such a lock on the business for so long that many think of it as a government statistic. The FICO score is used in about 90% of consumer lending decisions in the U.S., according to industry analyst estimates. And Chief Executive Will Lansing is one of the highest paid executives in the country. FICO dates back to 1956, when a Stanford University engineer, William Fair, and a mathematician, Earl Isaac, each put in $400 to start a company they called Fair Isaac. They invented the FICO score as a way to measure creditworthiness, or the risk that a borrower won't pay back a loan. For banks and other lenders, the scores became a game changer. A score supplied a quick, easy way to evaluate a potential borrower. In the 1990s, Fannie Mae and Freddie Mac made FICO the required score for their mortgages, cementing the American consumer dependency on FICO. The head of the Federal Housing Finance Agency, Bill Pulte, lit a match to the long simmering tensions this year when he suggested FICO was engaged in anti-competitive behavior. FICO and any other monopoly who has ripped off Americans for decades should not be using improper efforts to threaten regulators, he wrote on X. He opened the floodgates by declaring the Vantage score could now be used instead of FICO for many mortgage approvals. So Vantage score says it can increase access to credit for more consumers and help people who have limited credit histories buy homes or cars. To the chief executive of FICO, Choice encourages mortgage participants to shop for the most lax score and will create a race to the bottom. That risks American taxpayers being on the hook if something goes wrong. The FICO score is the backbone of safety and soundness in the mortgage industry, Lansing said on a July conference call that they discussed earnings. What once seemed to be a very cordial and mutually financially beneficial relationship between four companies now seems to be closer to war, said John Alzheimer, who also worked for or has been affiliated with all the companies over the years in various roles, including working with FICO scoring models. This reporting is based on conversations with more than a dozen individuals involved in the industry, most of them current senior and mid-level executives with the credit scoring and reporting companies. So, then they get into like, how is the FICO score, determined? Vantage Score claims it could calculate credit score for millions of people who often don't have FICO scores. Vantage Score found a supporter in a then up-and-coming Senator Tim Scott, a Republican who is now chair of the Senate Banking Committee. Vantage Score's pitch that it could help more people, including minorities, become homeowners, particularly resonated with Scott. Around 2014, the federal government began exploring whether changes should be made to the credit score used for mortgage underwriting, including looking at VantageScore as one option. Lansing, who got his start at consulting firm McKinsey and held the CEO job at several companies before FICO, saw a path for FICO to start boosting its profits. So FICO hadn't raised the price for a signature mortgage score product in decades, and it still sat at a few cents per score. Some executives at the time continued to believe their main purpose was doing the Lord's work. The CEO and his top deputies thought they had long been underpricing the FICO score. They believed a big gap existed between the few cents FICO was charging for its scores and the value it brought to consumers being able to attain credit, lenders being able to originate more loans in the broader U.S. financial system. Some executives told Lansing it seemed like the wrong time to make a move. They were all expecting a decision from the government soon on VantageScore, and they worried that a price increase would give the credit reporting firm and VantageScore ammunition against FICO. Yeah, they were right. Lansing saw it differently. If the government decided to stay with FICO only and FICO increased prices, it would give critics ammunition to call it a monopoly. So privately, FICO's leadership was getting annoyed with having to partner with credit reporting firms, which were becoming more and more competitors. So, and we see this interesting chart here, beginning raising prices for the FICO scores here. The Fair Isaac share price. So in other words, they started raising the rates, and obviously their share price really started to go off. It really took off here around 2022. You can see the share price really going up, but it's since come a way, went up to about $2,000 and has since come back down here. Again, Lansing, I think what's interesting here about Lansing is that he saw an opportunity to really get, really squeeze more juice out, right? Really say, oh, hey, we haven't raised our prices in a long time. But I think he got too greedy, and I think he basically set something in motion here that's really beginning to backfire on him. The other thing I would point out is you had what was called the target leads. Now, Lansing wasn't exactly with the target leads, or I'm sorry, the trigger leads, but then the three credit bureaus, Experian, Equifax, TransUnion, they were basically selling every time somebody went in to apply for a mortgage, they were selling that to other mortgage companies, selling that data. And then people, so if you applied for your mortgage, people were getting, 50 calls as soon as they applied for a mortgage from all different kinds of mortgage companies. Thus the trigger lead. That is, since now legislation has been put through to basically tamper that down, which is a good thing. But again, another kind of, I would call, like, unintended consequence here. So then we get down, when they talk about, kind of annual FICO revenue here has gone up. The Trump administration, they get into, like, Pulte basically saying, like, no, we want to get VantageScore out there. So FICO decided to allow the tri-merge resellers to calculate scores themselves by making its black box more available. FICO will charge those companies $4.95 per score, plus an additional $33 if the loan closes. The move cuts out the trio whose shares sank while FICO surged. They responded with deals that include giving away VantageScore free for many loans. The government, meanwhile, keeps pushing for more change from FICO, credit reporting firms, and VantageScore. Pulte said on X, this is just the start of competition and credit scores for the benefit of the American people. Well, I can tell you the problem with all this, though, is that in the banking business, all we've seen so far is the cost of the credit report going way up here. I mean, it's gone from, some people were probably charging, $30 a credit report. It's now, it's now up to, probably $45. If you're ordering a tri-merge, report, getting the report from all three credit bureaus, it's credit reports have gotten very expensive as of late. So far, I'm not really seeing, a tremendous amount of benefit here on the part of this war between the so-called war, between these four companies here. So we'll have to keep an eye on this. We'll have to see see how this all kind of festers out at the end of the day, but this doesn't seem like something that's going to end soon. I just wanted to make people aware of this because, the good thing, you're probably going to have more options here very soon in terms of what credit model or credit score that you use to try to get lending. And again, if you're using Vantage Score, or if you're just going to FICO, whatever, there might be some benefits to that. But it's also going to cause a little bit of disruption too in the short term. And for banks, just again, mainly just pulling credit reports on people. Unfortunately, the price of that product is going up in the short term. So again, just wanted to bring everybody what I thought was a very interesting update on a lot of credit scores. Like we said, we've seen credit scores falling a little bit. We've seen more consumers using red payments and stuff to kind of boost their credit scores, what we consider alternative data. And now we've seen this fight between Fair Isaac and the credit bureau reporting bureaus themselves. So again, some pretty interesting stuff happening here in the world of credit scores and credit reporting. So with that being said, I will wrap up by saying if you like this episode, please make sure to like, share, and subscribe, as that always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I always love getting back to everybody. And as always, make sure to check out some of the other content on the channel. I thank you so much for listening. Have a great day out there, and I will see everyone again real soon.